how we process information, the speed that we're processing information, and the output of that information is changing so quickly. A lot of firms are trying to figure out where do they deploy and invest in technology and in AI, and then how does that impact the people delivering those products in a way that we probably haven't seen before in this industry. As leadership, you have to define what you want to deliver to the market and be focused intently on delivering that.
Welcome to Leading Through Uncertainty, our interview series which focuses on how leaders navigate complexity and change. I'm Anne Murphy. I lead the Global Financial Services practice at Odgers, and today we're going to talk about asset management. I'm joined by my colleague Kevin McKeon, who leads our US Financial Services practice and is also a specialist in all things buy-side, so across wealth, asset management and alternatives. So welcome, Kevin. Great to have you with us. Before we get into asset management, it would be great just to hear maybe a little bit about your story. What got you into executive search?
Yeah, so like a lot of us, I sort of found my way into executive search. Of all things, I was studying to go to medical school in the States, and a friend of mine was working at an executive search firm and said, hey, why don't you come do a few months before you go off to school? And that was in 1998, and here we are today. So like a lot of us, fell into it, didn't go to school for it. However, I was a biopsychology major, so if I think about some of the things that I do on a daily basis, or we do on a daily basis, a lot of it revolves around human psychology. So maybe without knowing being a biopsych major, I knew that at some point I was going to get to executive search.
Mm-hmm.
So.
And you've been in it a long time. So what is it that you love about it?
What I love most about executive search is just the human dynamic and, back to what I was talking about, the psychology of it all. If you think about what we do, we're changing people's lives on a daily basis, whether that's someone earlier in their career or someone towards the end of the career going on to a board. I love that element of it. I love really getting inside someone's head and trying to figure out what their motivations are, whether personal, professional, financial, all of the above. Mm-hmm. So again, going back to my undergrad schooling, I think the psychology element of what we do is fascinating.
Mm-hmm. Mm-hmm. I think we have that in common. And we welcomed you into the Odgers fold earlier on this year with the team. How's it going so far, and how's your experience been?
It's been fantastic. I was a co-owner of a boutique executive search firm called Ridgeway Partners, headquartered in the States, and we were approached by Odgers May of 2025. And really for us, it was about capability and scale. And to date, we arrived here in early January. It's proven itself out. So I couldn't imagine a firm that allows us to serve more clients in many parts of the world, while at the same time, the capabilities, inclusive of executive search, but beyond that in terms of leadership advisory, has been really impactful with our clients. Those that we couldn't serve in that fashion before, it just builds our tether with them much stronger than we ever have.
Excellent. And as you think about the asset management industry, for you, has there been a sort of career-defining moment, something that's made you think about the industry in a different way?
Yeah, I'd have to say I was fortunate enough to spend 6 years in-house at Fidelity Investments, and that was an amazing experience for me. So that was back in the early 2000s, but I was able to partner with our chief investment officer of our institutional asset management business at Fidelity, and watching some of the decisions that are made in-house, some of the decisions that are made by portfolio managers, product developers, where we're going to go, how we're going to do it, what we're going to deliver, and then as a result of that, what is the team required to go and deliver that? That was pretty fascinating. So that was 6 years. I returned back into executive search in 2011, and ever since then, I look back to that Fidelity experience very fondly because I feel like, at least for those 6 years, I knew how the sausage was made, and that was pretty interesting, especially now working with clients, working through challenging situations. I feel being in-house and being part of that large organization was really impactful in my life.
Yeah, brilliant. And there has been a huge boom in alternatives, particularly for retail investors and the demand there. What's been the impact of that on asset managers?
Yeah, so I think over the last decade, if you look at what alternatives has become, especially in terms of mainstream investing, it's been pretty astounding. We see it on the front lines in the U.S. where we're probably sort of on the bleeding edge of a lot of these different things. And, it's shifted the dynamic within asset managers and within the investment management industry tremendously. I think about, for the longest time, if you looked at alternatives, you would see that how they were producing returns and where they were getting those returns from, candidly, what was not that easily to understand. And so now you think about the retail investor and you think about, the demands for information, the demands for education. That has really changed how investment management firms, in particular alternatives managers, are delivering these products. And so I think this veil of secrecy has come off. Whether that's good or bad, we'll see. But I think that's probably been some of the biggest impact that we've seen is just how these products are delivered and the information that is going to the investor base that never before has been seen. So that's been pretty interesting to watch and to observe, and just seeing the dynamic that's been playing out within these investment managers as that's taken place.
And the shifts that's brought in things like the product suite, distribution, talent, reward. Where do you see the biggest impact for firms?
Yeah, so I think the biggest impact right now has been around product innovation, product delivery, product education. And if you think about, outside of what I'll call the mega alternatives players, such as an Apollo or a Blackstone, a KKR, they've tremendously had to shift how they deliver product and the information that goes along with that. So I think from a product structuring perspective and a product delivery perspective, that's probably be the biggest change. As it relates to talent, what does that mean? I think you're seeing, many more organizations today bring on product strategy, product development, and really thinking about the vehicles, whether that's an interval fund, whether that's an evergreen fund, whether that's a BDC, how they're delivering these products into the retail masses. That's probably been, a pretty substantial impact on these managers. Beyond that, compliance, risk, legal, all these things have to be factored in. And, again, depending on how you would calculate what the retail asset base is, that's probably added jobs across these organizations in ways that some of these asset managers have never experienced before. So that's been pretty interesting to watch.
Yeah. And if you look into your crystal ball, what would you say the future is going to look like in this space?
So I don't think there's any slowing down, what's being delivered to the retail space. I think that there are plenty of opportunities, whether that's a historically or a manager who's historically delivered traditional product getting into this space. I think there will still be innovation around infrastructure products, real assets products. More recently, over the last year or two, hedge funds have come back in a way that for a long time, have not been present. So I still think that there's going to be product innovation. I still think that there's going to be plenty of opportunities for new entrants to come in. One of the biggest challenges, though, for all these managers is scale. So if you look at the retail space in particular, the massive scale, and then in the United States, the next frontier is retirement plans. And there's been a lot of press around how some of these managers are thinking about, through regulatory changes, how they're thinking about getting into retirement plans. So I don't think we're slowing down. I actually think we're only speeding up. And I think that's a great opportunity for individuals. I think it's a great opportunity for managers to participate, and I'm really excited for the future and what happens.
Great.
I think another big impact that's coming to light is how compensation structures and candidly how compensation levels are shifting. And I do think that that's one of the lasting impacts, for our industry is around, how this compensation or how compensation philosophy is changing. And so, whether that's, paying fundraising professionals, with carry, whether that's doing something different if a firm cannot pay carry. I think there are ways to pay and reward people that we've never seen before in sort of the traditional space. So I think that's another impact and change that's coming to these managers, especially the managers that are developing alternative strategies, are buying alternatives managers and bringing those into the market. That's going to be a change too that I think is for the better. I think that, again, there's more transparency around pay now than there's ever been. But that is something that I think managers are going to have to continue to be on the forefront of, especially in terms of retention of talent. I think if you believe as a traditional or historically traditional manager that you can pay your fundraising professionals, your investment professionals who are managing alternative strategies in the same exact way as you've paid folks in the past, I don't think that's going to work, and I think you're going to have a hard time retaining them. So I think that is something that is continuing to shift, and we're keeping an eye on as well.
Yeah. And if we turn to the impact of AI on asset management, clearly, whether you're an investor, an asset manager, a regulator, a customer, there's going to be a huge change. And I think there seems to be a general agreement that we're moving from an environment of productivity and efficiency gains to something which could be a much more fundamental strategic change for the industry. What do you think the impact will be on fundraising specifically?
Yeah, so I think from an AI perspective, we're just seeing some of the early movers as it relates to AI. And I think specifically in fundraising, I think it's going to shift the responsibilities of the fundraiser in ways that we haven't seen before. So if you think about it, I think the amount of data that our fundraisers are going to have at their disposal and the amount of strategic data that their clients have, whether that's an institutional client, whether that's a retail client, in 3 to 4 years' time, you're going to be able to look at any sort of type of investor and probably have a pretty good understanding of what they're doing and how they're doing it. So I think the actual information that's going to come forth for these fundraisers on their client type is going to be something like we've never seen before. What that will then mean is I think there's a scenario here where fundraisers will be required to, bring more information, bring more clarity to what they're selling, to how the products that are being built are to perform. And I think, as you think about AI, we're talking a lot about, what it means for the asset manager and the information they're going to have at their disposal. But the flip side is the investor is going to have quite a bit of information about the manager that is serving them. And so I do think, whether that a way a fundraiser is presenting information to a client, whether that is the type of information that's even being presented, I think that will shift. I could see a scenario where, we may have fewer fundraisers, but more impactful fundraisers as a result of that, as a result of the AI shift. But, I think this is going to play out in the coming years. I don't think we're there yet today, but I do think it is something that a lot of firms are trying to figure out. Where do they deploy and invest in technology and in AI? And then how does that impact the people delivering those products in a way that we probably haven't seen before in this industry?
So it could actually raise the bar in a number of ways.
Yes.
Yeah.
Yes, very much so.
And what about from the fundamental research perspective?
Yeah, so that's a really interesting one. So I've talked to a lot of CIOs about who are running research teams or are responsible for research teams and fundamental research functions. And they're looking at it sort of in two ways. So the first way is if you think about just the capacity of the human mind, right? There's only so much information, a research analyst can process at any given time. We are going into a world where that information, the quality of that information, and the processing that information is going to be done by AI. So from a research perspective, I heard one CIO talk about this. He was talking about the fan of information that a research analyst is going to have at their disposal now versus, hey, you have 30 companies and you need to go know those 30 companies intimately. So I think just the amount of information, coming into the research function is going to change dramatically. I asked the CIO this question recently. I said, do you think you're going to have fewer fundamental research analysts in 5 years' time than you do today? And he didn't quite have an answer yet because he thought about it and said, the one thing today that AI cannot do is to sort of process that information in a way and make conviction calls on that information. So his belief is maybe 90% of the information a research analyst is looking at today, can be processed by AI. However, that last 10% in terms of making the recommendation, showing conviction, today as I look at it, there's not an AI tool that can go into a company meeting with the CFO and read a CFO's body language, look for voice inflection. And so that from a fundamental research perspective is really critical because while the CFO or while the CEO is communicating information, the way they communicate information is a big part of the analyst's job to figure out what they're saying and how they're saying that. So I do think you're going to see a scenario here where there is much more information at the disposal of the research analyst. With that information, they're going to be able to process it quicker, come to conclusions more quickly. However, that conviction call on that information is still going to be a human decision. And so I personally don't think that we're going to have fewer research analysts. I do think, though, if you think about where AI can come in and help out a lot, it's at, probably the early stage career of research analysts, so at the associate level. So could we have fewer associates? Possibly. Do we have fewer research analysts? I don't know that. I also think there's this potential for a skills gap coming. So if you think about it, at the foundation of fundamental research is a bunch of early stage analysts and associates. If you have fewer of those, what happens to your foundation? Does it erode? So that's something that we're keeping an eye out for. But I do think of any part of the investment management process or any function within the investment management process, that is one we're keeping a very close eye on because we do think it's going to shift pretty dramatically. But will it go away? No.
And given what we do at the board, the executive leadership level, what do you think might be some of the other talent implications of some of these shifts?
I think firms are going to have to take a step back and think about what is the balance between technology and human capital. And today, I think many of the news headlines are fewer jobs, more automation. And I think for certain industries and financial services is included here, I think that's a real challenge that leadership teams, boards, and CEOs are wrestling with. I think there seems to be so much pressure on these leadership teams to come up with an answer, to declare an answer. And I don't think we're in a position right now to declare what that answer is, what that balance is. And so what we keep telling our leadership teams when it comes to things around data and strategic impact that technology can have sort of on investment firms, we just encourage them to be patient. We encourage them to explore all avenues. And I think over time, as I think we go from if you think about what a lot of us are using AI for today is to get answers that we would normally query through a Google search or an MSN search. I think when we get into sort of agentic AI and we get into things where tasks and functions are shifting how organizations are doing those, I think that's when a decision point is going to be reached. But really what we're preaching right now is patience to our leadership teams. Stay the course in terms of what you're doing. Think creatively how you could be arriving at a conclusion more quickly, more efficiently. But, I think there's many organizations that are kind of throwing the baby out with the bathwater to a certain extent, and just wanting to declare a shift to seem progressive, to appear like you're on the front lines. And I just don't think we have the information yet. So we'll see.
We can't really have a discussion about asset management without touching on private credit and some of the recent headlines in particular. So the IMF, regulators, big bank CEOs, we've got lots of commentary on whether or not there is a private credit bubble and whether there's going to be a systemic impact from that. As you think about the environment, maybe in the US over the last 5 years or so, what would be your observations on the private credit market?
Well, it's been quite a ride, to say the least. So if you look back to 2020 to where we are today, we've effectively doubled our private credit assets. So today, depending on what stat you read, we're up to about $2 trillion US dollars in terms of private credit assets. And I think where we have moved from, 5 years ago, especially with the arrival of investment managers, alternative investment managers coming into the scene, we've clearly gone from a niche asset class to something far more substantial than that. And so I think in part we're sort of living through that part of the cycle right now. I think all the headlines, if you go back, 6 months ago, 9 months ago, were around some of these defaults, and they're real defaults, right? But if you actually looked at the default rate, over the last 3 to 4 years, it's probably hovering around 2%, which is remarkably low. Now, what I would say is, market dynamics starting in 22 and 23, as interest rates started to move, have started to shift, and I think the impact of those shifts on the private credit marketplace are just starting to play out. So you are seeing default rates go up a little bit. But if default rates go up from 2% to 6%, is that really a crisis? It probably feels like a crisis compared to where we were because, 3 years ago, 2 years ago, all it was going up, up, and up. But I think that's more headline than it is actual crisis. But, one of the challenges around all of this has been, if you look over the last 5 years, going to this $2 trillion mark, a lot of those assets have come in from the retail investor. And as a result of that, I think that there is some panic within the retail investor. And that panic is playing through in terms of withdrawals or requests for withdrawals. We've all seen the headlines about these gates being put up in terms of some of these private credit structures. So unfortunately, I think some of these private credit managers, some of these direct lending managers are being negatively impacted for things that they have nothing to do with, right? And so. It's sort of the good and the bad about retail investor money, right? Retail investor money can come in very fast and go out pretty fast, and that's what we're seeing right now. I think some of the best managers in the space are going to prevail. I think it's going to shake out some of the weaker managers with maybe underwriting policies, but I think this is a moment in time. I mean, it may just be. We're going through a credit cycle right now, or in the beginning stage of a full credit cycle, and that's sort of playing itself out. So, I am not as worried maybe as the headlines make it out to be, but it is something we're watching, right? And beyond the retail investors getting jittery. some organizations have built up the majority of their asset base on retail assets. So I think those are the ones that you're starting to see some cracks in the foundation, and those are the ones that maybe aren't here in 2 to 3 years. Maybe they're acquisition targets for larger managers. So I also think this is an opportunity for some of the largest scaled managers to scale even further, to bring on capabilities that they originally did not plan for. So for some, it could be the end of the road, but for others, it can be a huge opportunity.
And so do you think we'll see a reset in the private credit markets?
Taking a breath around sort of where private credit is today, what a comfortable default rate will look like. I think all these things are starting to play through. So again, I think for those who have the ability to be patient, for those who can think about not only the next quarter, but 6 quarters, 8 quarters, 12 quarters in the future, I think this is a good moment in time. If this allows for a cleaning of house to a certain extent, I think that's a good thing. But is it a full reset? And are we going to reclassify or recalibrate how we look at private credit? Probably not. But I do think there is a shifting in the balance of private credit, and one that we're watching pretty closely.
And I guess all in the context of an evolving regulatory regime as well.
Yes.
Yeah.
And I think does some of what's happened over the last 9 to 12 months in private credit, does that get regulators more focused on the transparency of performance, the transparency of the underwriting process? If that is the case, I think that's only a good thing, right? I know asset managers and investment managers get scared of regulators from time to time, and that's totally warranted. However, if you have a segment of the market that is running untouched or unobserved, that's not necessarily a good thing. And so I think some regulatory impact in a good way is probably warranted, for what's happened over the last 5 years, and we'll see how that plays out.
Yeah. And looking ahead, if you think about the next, say, 12 to 18 months, what do you think successful leadership will look like in asset management?
I think leaders, as I said previously, will need to take a step back and think about what are they trying to accomplish. So, I think that, we're going to come to a moment where an asset manager or an alternatives manager has to think about who we are to the marketplace, what we are to the marketplace, and how we're delivering that to the marketplace. And I've always been impressed with managers, whether alternatives or traditional, that have stuck to their knitting. And I think now, probably like no other time, it's important to stick to your knitting about what you do, what you produce, and how you deliver that. I do think we're coming to a moment in time like we've never seen before, and some would argue back to the rise of the internet and how that changed our landscape. But how we process information, the speed that we're processing information, and the output of that information is changing so quickly and so dramatically. It's hard to predict what even investment management and asset management is going to look like in 5 to 10 years' time. I believe, we're coming to a moment in time where the traditional style box is going to go away, and we're going to be very results and outcome oriented. And I think you're going to see products being delivered to both retail and institutional investors that are solutions based and not product based. And so I think we're at this moment of time where, as leadership, you have to define what you want to deliver to the market and be focused intently on delivering that. I also think there's going to be an opportunity to look at your cost basis and how you're performing, or an asset manager is performing the duties that are upon them, and think about, is there a better way to do it? Is there a more efficient way to do it? Now, a better, more efficient, cheaper way to do it doesn't mean it's the right thing to do, right? And I think that leadership is going to have to wrestle with some of those decisions, right? It's very easy to cut costs if you look at, hey, I have I have 5 headcount and I can replace those 5 headcount with, a technology spend. Okay, that's factually correct. Is that the right thing to do? Is that going to lead to the right and consistent outcomes that you're hoping for? I don't know. And so again, we've been preaching a lot of patience, to our leadership teams, to the boards that we serve, not to take their eye off the ball and not to think about innovation, but to be cautious with that innovation. And again, think about what it is you're trying to deliver and try to deliver that in the best way possible.
And on the subject of boards, and given that context, what advice would you have for boards as they prepare to navigate that next period?
Advice I'd have for boards. So I think one of the pieces of advice that I'd share is ask a lot of questions. I think boards are typically pretty good at that, but they're going to be probably asking questions that they've never asked before, and I think that's a good thing. I also think boards are in a somewhat difficult position because what has gotten the companies for the boards that they serve on to this point in time is probably not what's going to get them or bring the success over the next 5 to 10 years. And so I think it is a tricky subject to navigate. It's something that, again, requires a lot of questions. And I think, boards do a really good job of thinking about life and success through regulatory outcomes or through regulatory environments. And I think we're continuing to encourage them to ask difficult questions, around the regulatory elements of these products that are being produced by these asset managers. And so we will see, sort of the board impact, on an industry that is going through such radical transformation. And the other thing too, about asset management in particular is there have been some managers who've been sort of on the forefront of innovation, but there's been a lot of managers that have kind of gone, more steady Eddie, if you will. I actually think that those managers in a time like we're facing right now with so much uncertainty, it's not a bad thing to be a steady Eddie manager. But I do think it's going to put more pressure on boards. I do think asset managers, alternative managers are going to have to think about the composition of those boards. I think boards having more technology-oriented leaders on them are better than not. But it is a fascinating time for boards, and it's a fascinating time for leadership, and it's one that we like to deal with every day, and we like to help them try to solve problems every day, and so it's been fun to be in this industry at this moment in time, and I think the fun is just beginning.
And given the breadth of your experience advising leaders in this space, if asset management leaders take one thing from this conversation today, what would it be?
Patience. I think it's a moment in time where there's so much we can do, there's so much we want to do. There seems to be ways to do it faster, more efficiently than we've ever had before. But again, I go back to saying just because those opportunities exist doesn't mean those are the right opportunities for us to pursue. Mm-hmm. So I think having this patience, having this focus on who you are, and what you're trying to deliver is now more important than ever.
That feels like a perfect place to wrap up. So with that, Kevin, thank you so much for joining us and for sharing your insights.
This has been great. Thanks, Anne.